Welcome to Green Bicep, the signal from the noise. This is week number 14. Let's get to it. The market rallied last week, but unfortunately, it looks like things are starting to sell off this week. You can see year over year, the market was down about 11%. For the week, was up about 4%, but today is Wednesday, and the market is selling off. Several banks have broken through major support, and they're slipping down. We're going to see banking pressure. Watch Charles Schwab closely, or those invested in Charles Schwab as well. So when you look at this chart over here, you look at the NASDAQ, you could see that the NASDAQ has rallied quite a bit, just like the Dow has rallied quite a bit. And the advanced decline line on the Dow has gone up too. That means there are a lot of advancing stocks. Well, when you look at the NASDAQ, it's been flat. So expect a correction in the NASDAQ as well as the Russell microcap. And so I would say we're in a situation where the yield curve is inverted still, and that means you want to be very cautious in your investment. That's why gold has been doing very well. Gold broke out. It broke out over $2,000 per ounce. So it hit an all-time high. Here we have a chart of the 2-year treasury yield on the government bond, and you can see the 2-year dropped down quite a bit. It says 26% in just a short amount of time. So there's massive moves in the bond market currently, and interest enough on the top line, this is actually Bitcoin, and so Bitcoin is quite an inverse of it today. Risk on versus risk off. And let's keep going. Tech rallied. 20 stocks on average drove a majority of the tech rally. I still have a target of a little over 3,000 on the S&P 500. Current state, several rate cuts are priced into the market. I don't think that's going to happen. Also, lending, credit impulse is you're going to see lending decrease because the banks are not receiving as many deposits, and so they need to maintain certain ratios. And credit quality will continue to be an issue as the consumer gets crushed. And so because of all of that, lending will drop, and so that will inhibit the growth within the economy. And there's no talk of CapEx, and that is what we need in the United States of America. We need to expand capacity. If we have capacity, prices will come down. Raising interest rates actually raises the cost of capital, and that actually increases the cost of goods. Raising interest rates passes assets from a debtor to a creditor. It's that simple. Don't be. Layoffs continued, and the circle reference will take effect. ADP came in this morning at 145. They were expecting 200. It's going to take some time for all. There's a lot of layoffs happening, so it will filter through. Gold broke 2,000. There might be opportunity in gold stocks. I mean, they're really overextended. So I personally want to chase, but if you're long-term looking out 3 to 5 years, it doesn't matter really. Target of 3,000 per ounce by 2025 is what I project. I threw in a healthcare just because I saw there's a lot of strength. So big institutions are shifting money around, and healthcare is probably, we're gonna dump some capital, like Pfizer, for example. Yeah, so 3,000 per ounce. Commercial mortgage-backed securities, there's more issues to come. Blackstone halted redemptions for the 5th straight month. That is saying it all. You don't have to think too deeply about this stuff. Watch Charles Schwab. Schwab has been dropping down. There's just, they have a lot of exposure to these assets. Bitcoin has been steady at around 28K. There's been pressure on it, trying to push the price down. We'll see how this plays out. I think because of the global change in the BRICS and the world economy, Bitcoin is actually becoming an asset class, less of a speculative asset, which is good to see. There's a lot of changes that have happened in the last 5 years, And what really makes me more confident in that is that Fidelity is now offering it to all its clients. So if the SEC did not think Bitcoin should be traded, then why would Fidelity just offer it in the last month? QE will be the catalyst for Bitcoin to hit 100K. While gold hitting 3,000 per ounce by 2025, that would be part of the catalyst, would be QE as well. And for Bitcoin, it's the Bitcoin halving, where the inflation rate of Bitcoin is cut to around 1.75%, I believe it is. And so inflation for this asset class will decrease, unlike gold. BRICS. France's Macron, he's not part of BRICS, and Ursula, the European Commission, will head to China and play some risk, the battle game risk, with the president of China. And now let's talk BRICS. We're going to skip ahead 2 slides. So what's going on? China is expanding its influence. And if you read through here, each little flag, the OPEC nation, Saudi Arabia, has declared it will abandon the petrodollar and accept the petro-yuan. Brazil and China recently linked an agreement to trade in Chinese yuan and ditch the US dollar. Now these words might be dramatic. But the point is there's a trend away from the US dollar. So let's get back to it. And so because of that trend away from the US dollar, we might end up seeing regional currencies where the yuan is more in Southeast Asia, the dollar is more in the West, and you still have the euro. So you got 3 solid currencies right there. And I think that makes the most sense initially before the next level hits. And that's TBD at this point. And the regional banks will get a haircut. Most of them report earnings around the 20th of April, and we are at the 5th. And they're already starting to break down. So there's opportunity there. So quits rate increase, so more people are quitting their job, while the number of job openings did decrease to 9.9 million. And it was weakness. They were expecting 10 million. So people are quitting their job. You could argue why, and I don't know how they measure it. But the fact is, Apple is laying off, and that says it all. Apple's the largest company in the United States of America. So if Apple's laying off, what does that mean? It's pretty straightforward stuff there. Money market funds, they are costing the Federal Reserve approximately $7.5 billion per month, because these money market funds are, the Fidelity is real. They're taking cash and they're dumping it into the reverse repo, and then they earn 4 or so % from the Federal Reserve. You annualize that across all the what's in the reverse repo. It's in $2 trillion or so. It comes out to about $7 billion per month that the Fed has to somehow find cash to pay for. And the question I have is whether or not the reverse repo only has cash, or does it have mortgage-backed securities and other toxic assets? And I believe it does, but I have no evidence of that. Banks to require time deposits. So in the 90s, prior, you could go to a bank and they would potentially give you a toaster for opening a bank account, which was pretty cool at the time. And now banks need cash. So time deposits are like CDs, where you put your money in there and it's locked up. You can't get it out. They don't want you to put your money in a savings account or checking account. They want you to deposit money into time deposits. So the cash is locked up and they haven't. They could lend it out, or they could cover other issues when people with their investments into mortgage-backed securities. 2023 oil got a bid. We talked about this last week, and I'm starting to believe that Oxy discovered more than oil in this drilling, so that might have something to do with it. Or they just generate so much cash and their dividend is that large that Buffett likes it. But just seeing how aggressive he is, it makes me believe there's more to that story. OPEC cut production by 1 million barrels per day. So what does that mean? Ultimately, they're trying to control the price of oil, and you can see that the oil was trending down quite a bit and is in a range. And essentially in this period of time is when the President of the United States allowed the Department of Energy, I don't know who, but he signed something so that we could use our strategic petroleum reserves. And those reserves are for emergency situations like war. But he wanted prices to come down so we have less inflation. That's what Biden's fighting inflation. But at the same time, we get this trading range. He did not buy any oil during this time to refill the reserves, and now OPEC is trying to get price to go up a little bit more, push more inflation. That is good if you want rates to stay higher, and that will help squeeze out China because China's economy is weak. So there's a lot of things playing in this situation. I don't think it's all that straightforward. Q1 earnings are kicking off here, and the regional banks are really going to be the story, and their exposure to derivatives for the small and regional banks. That will be the story. So we will see a strong sell-off in the financial markets, and it seems to be kicking off. I thought it would have started sooner, but the Treasury and such and Jamie Dimon and team worked together hard to plug some holes to ensure that those few banks didn't go bust in total. And I'm talking about First Republic specifically, but there's a lot of other ones that I see as having issues. Mortgage rates are at 6.5. They've come down, but they're still high. It's helped put a floor on the housing market. We do have a shortage of homes across the United States, but the costs of those homes are too high, so there's an issue there. So we have the home builders are not building, and so it's squeezing out those that are just coming out of college. You better work for 10-15 years before you could buy a home today or get an apartment. Stretching the rubber band, the new normal war friction, who benefits the most? And from what I see is the Chinese are definitely benefiting, as well as Russia, China. And they're just teaming up and they're creating alignment with Iran, and there's a lot of deals being signed. And it's a good thing that we decided to, it's a good thing for them that we decided to support Ukraine and divide the world and strengthen the East. While at the same time we're focused on issues that are not relevant really to long-term national security aspect of society. TikTok bill, this is worth talking about. It's called the Restrict Act. The TikTok ban is the least worrisome part. The Restrict Act gives the federal government unilateral control to shut down any group of 1 million or more Americans doing anything together online. From what I hear about this Restrict Act, it's just basically you got the Patriot Act, and then this is just pushes it more farther with technology. So it's not a good thing, and people need to be aware of it, and you got to shoot it down. This cannot pass. If it passes, it would be fine if you could trust those in power, but it's proven, given what's happening to our old president, what they're doing to him, nobody is safe. If they could take a president and throw these like charges that are kind of they don't matter, the charges, right? He did, it's just, it doesn't matter. So they're just flexing their muscles. So this is why the Restrict Act needs to go away. And we need to pull away power from the government at this stage of the game. Otherwise, you're going to have actors, people in power that will ultimately come down on you if you go against them. And we've seen it over and over. And so we're at a critical time, I believe, in the United States of America. And we saw this. I'll pause it here so you could take a screenshot if you wanted to read it individually. All right, Brazil PPI, Producer Price Index. I found this to be interesting because it's only up 1.38% year over year. So this is implying deflation. If this continues, I mean, it's quite amazing seeing this. I was like, what? So I meant to go look at other countries, and I just did not have time. but it looks like we are in a deflationary spiral, at least in Brazil. We'll see if it could stabilize, and then the Fed might be, they raise rates again, they might be really destroying the world economy, and that might be the plan, is really to pull back on China to ensure they can't expand as much as possible. So you gotta I think you gotta think a few steps ahead, unless it's all just randomness and the Federal Reserve is just doing it for the fun of it. Price of oil we looked at. This is, for those that are the first time tuning in, the economy. What leads the economy is housing, then it goes into orders, profits, and employment. And you could see in each one of these charts with the line going down, that means that each category is getting weaker. Housing is getting weaker, orders have been getting weaker. We did have a turn up in housing, but it's still too early. The cycle has to play out. Now profits are just starting to turn over, and employment, it should just start to kick up. I would say it's possible that no matter what, profits are going to be coming down, and so this is going to continue and it will play out. So we'll see this trend down, and so what does it mean for you? It means if you're invested, cash is king, or you could try to get a 5-year bond or something like that, or you short certain industries if you're a trader. And this is illustrating the housing, orders, profits, employment, hope, the economy, and how the timing, how it goes from left to right, from July through December, and how first it hits inflation, then it hits permits, then the S&P 500 gets weak, and then industrial production, capital goods, new orders. And new orders did come in this week, and they were weaker. ISM is below 50, so that means contraction. So we're getting weak economic data continuously. This was prior. I kept it in here because it is important. China's who they import from here. It's European Union, Taiwan, South Korea, Japan. And then on this next slide, I just illustrate what countries they import from and how Fed was extremely weak in South Korea, Japan, and Taiwan. These are the exports of those specific countries, and they import quite a bit to China. So what this means is the Chinese won't be pushing inflation, which is a good thing. There's going to be less inflation because of the Chinese, and that means less likely the Fed is going to continue to raise rates. But they seem to be finding ways to raise rates. They're creative in it. This is just showing 7.9 trillion in uninsured deposits, so it's just something to think about. And then this is the smaller banks' assets continue to drop, and this is probably down to 4.6 now, or that's 400 billion, probably at least that. And then you can see banks were scrambling to get money from the Federal Reserve via the discount window. That's where they borrow money directly from the Fed and pay an interest rate. And these are the banks that Michael Burry highlighted in different quadrants. We'll call 1, 2, 3, and 4. In this quadrant 4, so we're going 1, 2, 3, and 4. This quadrant in the top right, as you go to the right, it's unrealized losses. So SIVB had a lot of unrealized losses on their balance sheet. SBNY has a lot as well, and they both are basically bankrupt. You got First Republic, they're being rescued. Then you got Co-America, and they haven't been rescued yet. USB is up there. Somehow Bank of America is up there. Huntington Key. So all these ones on the right, there's some risk, but it's not binary. It's not that simple. And then you have these other companies that also are carrying a lot of mortgages, or I should say commercial loans, and those are the ones you probably would want to focus on more. MTB is over here, very low unrealized losses, but they also, if you look at their financials, they have a lot of exposure across the board. Most of them do. Then this on the left is it's dated, but I went to like Huntington and said, did any board members leave in the last quarter? There's no. Co-America, two situations where they had to file two filings with, SEC. M&T Bank, there was 3 filings. So a lot of people leaving the board, and it's just a really consistent and odd pattern to see before March, all of this occurring. Here, banks are beginning to break down. The point here is showing prior support, and they're just dropping through it all now. And essentially, if you look, the drop in knife came here, then we consolidated. Now the banks are actually starting to break through the prior. Right here is a perfect example. This Valley National is now breaking through its old previous low, swing low in the last. So normally when you get the situation like this, it'll consolidate and it'll just slam back down. So it'll probably come, this 864 will come to probably to 650. This 29 will probably come down to at least 22, and then consolidate and rinse and repeat until they find their true market value. And that may, wash out, then it may pop back up in 2025 or 2024. But I see this playing out for a while, and some of these might be like that. The common stock might be worthless. We already covered this prior, and this is the market moves with higher when the Fed expands its balance sheet. I think it's just great to show this over and over. And so next week I'll make sure I have a Fed's balance sheet, and it did increase 2 weeks ago, and then I believe it decreased a little bit in the last week. So it contracted, but we'll see. Household debt and credit. I cut out a majority of the slides here from last week, and I just left 2. So this credit limit, it shows the available credit now today is greater than it was in 2008. And when comparing the balances, we're actually higher today. So we have more debt overall being used versus 2008 at the consumer level. And so the consumers will have longer before they max out their credit cards, unless credit gets cut first. And then if you look at total debt per capita, you can see that we have exceeded 2008. So that means there's a lot of people that actually have more debt than in 2008. It's not a good situation, to say the least. Baker Hughes, the rig count seems to have stabilized. Oil is finding a floor, and there is a lack of R&D and capex in oil, and that price pressure will be felt at some point because people will need oil, and if they're not invested in infrastructure, there will be a squeeze at some point. So that's why I continue to talk about oil. And now we're looking at the dollar index. The important thing about that dollar index is it's at a critical hold point, and it's likely going to continue to get weaker as we import more than we export. And also it plays in this commodity super cycle. For the commodity super cycle to take place, the dollar would have to break this line here and go down, and it looks like it will. So it's quite interesting seeing this play out. And then we get into sentiment. Sentiment is not a huge amount of change from last week. It's still kind of in the middle ground. I don't know. The sentiment indicator doesn't swing very much because I felt like we were at a very greedy point about a week ago, and it does look very greedy. It's all green, and so it's eased off a little bit, and now the market's turning over. And this is credit spreads we've looked at prior. It's just taking the 10-year note minus the 2-year bill, and essentially it's negative, and that implies that essentially the bond market is broken. And if you look at this, unemployment will tick up typically when this self-corrects. So we're getting there now. I would imagine in the next quarter we'll start to see unemployment ticking up. Here's Quad 4 Invest in. Hedgeye is one of the best in the industry, and basically they look at 4 quads depending on the cycle, and they say this is where you want to put your money if you want to be invested. And they're saying technology, you could go through the thing. Like we've had our run in tech, so you got to be very careful and just following things like this. This is consumer staples, REITs. REITs are going to get destroyed. Certain ones, you got to be very careful what you're doing now, because there's a lot of credit quality issues in our economy right now. And this is essentially quad 1, quad 2, quad 3, and quad 4, and then we're basically at the end of the cycle. And then you have a bear market, then you go back to, I guess, core. This is the list. I haven't been doing anything with it, meaning changing. I still believe the S&P is going to drop quite a bit. The 3-month bill stayed the same, which is quite amazing. But what we did see were huge swings in the 2-year, as well as 5-year, as well as 10-year. All the yields dropped. So somebody was buying those bonds, pushing the bond prices up while the yields were down. So that was a rush to safety. Now you can see why. Now the market's selling off today and yesterday. And gold is strong. There might be opportunity with some of the stocks. Bitcoin has been strong. I'm just going to zip through it. And then oil. So let's look at commodities. So when it comes to commodities, what has happened? Well, prices jumped a lot in the last week. Overall, prices jumped a lot in 1 week. When I say that, coal was up 12%, crude oil 10%. So energy was up a lot across the board. Year over year, it's still down tremendously, from 15 to 50%. Metals jumped up a little, silver and platinum, but in aggregate, metals were down over the last week, and year over year are down quite a bit, from 20% to 50%. Titanium was down 50% year over year. Now we're getting to ag. With agriculture, same story. I mean, this is more a mixed bag. We do have more price pressure here, with tea up 25%. Who's been drinking all that green tea? For the month and for the week was 16, with sugar was up 7, orange juice 7, coffee. It's like everything we need. It's so for the month, then year over year, tea was up 21, orange juice 75, coffee down 21, palm oil down 34 year over year, milk down 21, potatoes up 48% year over year. Well, cotton's off 40% year over year, lumber's down 57, rubber down 23. I mean, it's just a few of these food products that are folks might want to look into the manufacturing side of why this is not, prices are going up. It doesn't make sense to me. Like for food, you would have to have your raw input to the food even. Like for milk is from a cow, so the cow has to eat X, Y, and Z. So corn is up 2.9% year over year. Corn is down 12%. So what is making the price of milk go up so much? I know diesel, shipping, obviously shipping milk costs a bit. You got to ship it around. So I don't know, it just doesn't quite make sense. And then, but overall, I would say raw input costs are still dropping or not accelerating. I know core PPI came in, and core PPI was still sticky on the services side, and so it's the same story, but it's still like the vector is slightly down overall, and then the service side it's more sticky. So we'll see what the Fed wants to do. So how do you play this? Well, the play today is you short the banks, not a financial advice, but that's like the smart play, the regional banks specifically. You build up your cash position if you want to just watch this all play out. Go long gold, a little exposure to Bitcoin. You might see some, sectors, individual sectors doing quite well. Follow the smart money, the people like Warren Buffett, and see where they're putting their money, and they're looking out 3 to 10 to 15 years. And so they're not looking for these quick trades. But with the cost of capital as it is, with the credit quality, the risk premium going up, with war, you just got to be very tactical in the type of companies you invest in. You could invest in Starbucks, which has earnings of almost, say 30. I'm rough math, but it's extremely expensive. Starbucks is. So to me, that would be a great short play at some point. And I know that the stock has a great brand and all that stuff. So you can't just go short a stock. But the thing is, what is going to have the highest return over the next 5 to 10 years with the lowest amount of downside risk? And that's where you kind of want to be looking at it. And when you do that, is it what are people going to be buying? If people get laid off, are they going to cut back on their Starbucks? They're going to keep buying RVs, stuff like that. And for those that think this economy's roaring, well, look around you. All these tech companies are laying off, and now it's moving into other industries as well. So be smart, be safe, and I appreciate your time and tuning in. And I'm on Twitter as well, so I do post stuff, and it's pretty updated, like daily. And yeah, so you could potentially gain value from going there. If you like the content, thumbs up and subscribe. I appreciate your time. And this is Green Bicep, where there's only signal from the noise is here. Appreciate your time. Thank you, folks. And if I could close this out, I will. Cheers.